Welcome to the Deep Dive. Today we're cutting through the transcript of the Q3 2025 earnings call for Purple Innovation Inc. That's ticker PRPL.
And this was a really conflicting one. Management kept calling it an inflection point, pointing to all these big operational wins.
But the market's reaction seemed to tell a completely different story.
A completely different story. Immediate skepticism. The stock dropped pretty hard right after.
So that's our mission today, to unpack that paradox for you. We've got this incredible margin turnaround on one side.
And a pretty disappointing revenue number on the other.
Exactly. And we need to get into the wholesale channel growth and tackle this huge risk that's now hanging over everything. The Nasdaq listing issue.
It's a big one.
Okay, so let's start where the market started. The reaction. The stock closed down, roughly 11% the day after the release?
Yeah, that's right. It was clear the street was laser focused on one thing.
The top line miss.
This top line miss. They just didn't deliver the growth story people wanted. Revenue was $118.8 million.
And the consensus was looking for something closer to $123 million, right?
$123.2 million to be exact. So a clear miss.
But management did try to frame that as a bit of a moral victory.
They did, and you can kind of see why. That number, the $118.8 million, was actually flat year over year, up just 0.2%.
Which for them was a big deal.
It was. It stopped a really long streak of consecutive year over year declines. So, they stopped the bleeding, even if it wasn't the growth people hoped for.
So if revenue was the bad news, where was the win? Because there definitely was one.
Oh, it was all about profitability, pure discipline. Adjusted EPS was a loss of 8 cents per share, which actually beat consensus of negative 9 cents.
Okay, a small beat.
A small beat, but the big number was adjusted EBITDA. They hit positive $0.2 million.
Wow. And that's coming from a pretty significant loss a year ago.
A massive loss. A loss of $6.4 million in the same quarter last year.
Okay, that swing is remarkable. To go from losing over $6 million to breaking even, especially when you missed your revenue target, that's all internal execution.
100%.
So let's drill down into that. How did they pull off positive EBITDA?
It's all cost control and gross margin expansion. And honestly, the gross margin figure is the number that just jumps off the page.
What was it?
42.8%.
Wow. Okay, and what was it a year ago?
It was 29.7%.
Wait, say that again.
29.7%. That's a 3,310 basis point expansion, 13 full percentage points.
And that's not incremental improvement. That's a fundamental change to the business.
It's a total restructuring of their cost base.
So where did those savings come from? It has to be more than just cutting a few expenses.
It is. Management pointed directly to lower fixed costs from their plant consolidations, especially the big restructuring they did at the Georgia facility.
And they put a number on that, right? The expected annual savings.
Yep. They reiterated they're on track for $25 to $30 million in annual savings. And you can see it in the P&L. Overall, operating expenses were down over 23% year over year.
And that lower fixed cost base, it fundamentally changes the risk profile. Didn't they give a new break-even number?
They did. This was really interesting. They said the company used to need somewhere between $55 to $60 million in revenue per month just to break even.
Okay.
Now, after the restructuring, they think that number is closer to $40 million a month.
So in theory, every dollar of revenue above that $40 million mark should flow to the bottom line much, much faster.
That's the theory, higher operational leverage. But we do have to throw a little caution in here.
A fourth quarter.
The fourth quarter, it's always the most promotional time of year. Holiday sales, Black Friday, all that discounting is going to test that beautiful 42.8% margin right away.
Good point. Okay, let's shift to the strategy side. This whole path to premium sleep idea, it's all about moving away from that old DTC model.
Right, and the channel that's really proving the strategy works is their own physical showrooms.
They were strong, right?
Very strong. Showroom revenue grew 6.5% to $22 million. And get this, comparable sales were up 12%.
12% comps in a mattress category that they themselves called flattish and highly promotional. That's impressive.
It really is. It shows the premium strategy is landing with customers. The average order value for a mattress in their showrooms is now about $4,500.
Wow.
And that's flowing through to the bottom line. 76% of their showrooms are now EBITDA profitable year to date. Last year, that figure was only 56%.
So the showrooms are the proof point. Yeah. But wholesale, that's supposed to be the real growth engine for the future. What's happening there?
Wholesale revenue was up 8%. And that's being driven by two things. The new Rejuvenate 2.0 premium line, and this is a big one, the expansion with Mattress Firm.
That partnership is central to their whole growth story for the next couple of years.
It's everything. Right now, they're in about 9,200 Mattress Firm slots.
And the target is?
The target is a big ramp up to 12,000 slots by March of 2026.
And what's the revenue impact they're forecasting from that?
They're guiding for about $20 million in incremental revenue from it in 2025, and then a pretty significant $70 million in 2026.
70 million. I remember that number getting a lot of attention in the Q&A. That's a huge projection.
It is. The analysts were definitely pushing on how sustainable that is, as they expand. But it's not just Mattress Firm. They're also expanding with Costco.
Okay.
They're in a Q4 furniture event in at least 450 clubs, which is almost double what they did last year.
So with showrooms and wholesale doing the heavy lifting, the old engine, e-commerce, must be taking a back seat.
Oh, yeah. It's the laggard for sure. E-com revenue was down almost 10% year over year.
Ouch.
Yeah. But management said they're seeing some sequential improvement after a site refresh, and they're getting more traction on Amazon. But you're right, it's now positioned as a long-term thing, not the primary driver it used to be.
Okay, so strong execution, a clear strategic pivot, and yet the market punished the stock. We have to talk about the risks, starting with the outlook.
Right. Well, they reiterated their full-year guidance for 2025. Revenue between $465 and $485 million, and adjusted EBITDA between break-even and positive $10 million.
So they're holding the line, which shows some confidence.
Mm-hmm. But they did warn about Q4 margins.
Right, the promotions we talked about.
Exactly. They expect Q4 gross margin to drop a bit to around 40%. Still a great number for them historically, but down from that high in Q3.
And then there's the whole strategic review.
Still ongoing.
Yeah.
That started back in March 2025. Could be a sale, could be a merger, but they refuse to comment on it at all in the Q&A.
Which usually means it's either very serious or completely stalled.
Right. Either way, it's an overhang of uncertainty.
But the biggest overhang, the one that probably trumps all the good operational news, is the compliance issue. The dollar stock problem.
This is the critical binary risk. On November 5th, the day after the earnings call, they got a formal notice of non-compliance from Nasdaq.
Because the stock is under $1.
Right. The minimum bid price rule. The stock's trading around 73 cents, and now they have a clock. They have until May 4th, 2026 to get the price back above $1 for 10 straight days.
And that just changes the whole investment case, doesn't it?
Yeah.
Because now there's this external deadline that has nothing to do with their operational turnaround.
It complicates everything. And the obvious question is, what if the turnaround doesn't lift the stock price in time?
You start hearing whispers of a reverse split.
Exactly, which is a tool they can use, but the market almost always hates it. It feels like an admission that you can't get there organically. So far, they haven't committed to one.
So you've got this incredible operational story just colliding with a hard structural risk.
Yeah.
That kind of asymmetry is...
Well, it's fascinating from a trading perspective. So let's shift gears to our segment where we pitch an outrageous but plausible trade idea. And just to be clear, this is to provoke thought, not action.
And this setup is, it's perfect for it. You've got the deep operational wins, positive EBITDA, 40+% margins, crashing right into this severe time-sensitive listing risk.
And the ongoing strategic review as a potential catalyst.
Exactly. So it's a leveraged, catalyst-driven play. So what's the structure? How do you play that kind of volatility?
Well, one idea is to build a risk-defined asymmetric long position. The simplest way is you buy the stock, right? Say 1,000 shares at 73 cents.
Okay, so you're betting on a buyout from the strategic review to give you that big premium pop. High risk, high reward.
Right. But to protect yourself on the downside, because the risk of delisting is very real, you can build in a cushion.
How?
You simultaneously sell covered calls against those shares. Let's say you sell 10 call contracts with a strike price of $1.50, expiring just before that May 2026 Nasdaq deadline.
Ah, okay. So the cash premium you get from selling those calls immediately lowers your cost basis on the stock you bought.
Precisely. It gives you some downside protection. So if the company gets acquired for, say, $2.50 a share, you capture all that upside to $1.50.
Huh.
If the stock just organically recovers past $1.50, you also win.
And if it all goes wrong, if the strategic review fizzles and they fail to regain compliance,
well, you still have that premium you collected up front, which mitigates some of your loss. It doesn't eliminate the risk, but it cushions it. It's a defined risk bet on a catalyst.
So to recap this whole story, Purple Innovation delivered a really financially disciplined quarter.
Absolutely. unprecedented margin expansion, back to positive adjusted EBITDA, and the strategy in showrooms and wholesale seems to be working.
But the market can't see past the revenue miss, and, more importantly, this huge non-operational risk from the Nasdaq bid price notice.
Yeah, it's a perfect example of a great internal, operational story fighting a very skeptical, structural, external narrative.
Thank you for joining us for this deep dive. We'd really encourage you to analyze that gap between the company's internal progress and the market's current pretty depressed valuation.
And remember, all the information discussed here is for educational purposes only. It is absolutely not financial advice.
Until next time, stay well informed.